If you're 65 or older and you have multiple seven figures inside of tax-deferred IRAs and 401ks, you might be thinking, the One Big Beautiful Bill Act just gave me more room to do Roth conversions. Well, maybe, but maybe not. Depending on your income and how much you're converting, the One Big Beautiful Bill Act, formerly known as OBA, may not have moved the needle as much as you had hoped. So in today's Whiteboard Fireside Chat, I'm going to look at a client case, Jack and Barbara. They're both 65 as of 2025 and also retired with about 2.1 million inside of tax deferred accounts. They also have a pension that's going to pay out about $25,000 annually. This is in Barbara's name. And then Jack and Barbara, they do plan to start Social Security at full retirement age, FRA, which for both of them is age 67, and that's going to total $60,000 on an annual basis. But there is going to be a bridge of 2 years until Jack claims Social Security in early 2027, and then ultimately Barbara starts her Social Security in late 2027, and then beginning in 2028, that's when they're going to have their first full payment of roughly $60,000 adjusted for inflation. In terms of their spending goals in retirement, the big thing for them, they just want to sustain the lifestyle that they're comfortable with. They don't want to have to worry about money. They loved their previous lifestyle before they retired, but they've been retired for a few years and they want to continue that lifestyle. So they factored in based on their cash flow needs and also building in healthcare and even some buffer for basic travel expenses. They need about $108,000 on an annual basis to satisfy those expenses. I would characterize this as the needs in the financial plan. Certainly, there's probably some buffer in there with regards to travel or eating out, things of that nature. But for retirees that we work with, they want to maintain their lifestyle. They don't want to reduce their lifestyle in retirement. So let's say their needs are about $108,000. Again, for lifestyle plus healthcare, but they also want to take some bucket list trips in the next 10 years while they're physically able to, while they mentally have the stamina to do so. And the target there for them is $10,000 a year. And we like to call this the go-go years. You don't know how long you're going to go-go. Some people go-go for 15 years. I have clients that are over the age of 80 that are still doing some travel that frankly even our 60-year-old clients aren't doing. So I think it depends on what your definition of go-go is. It depends on what you want to do in retirement. For this couple, they want to be active. They want to go places, particularly, like I said, these bucket list trips that they've always wanted to take, and they want to build that in at least over the next decade while they feel like they're still in Superman and Superwoman health. Here's what we did. We started out in our tax planning software, Holistic Plan, and I just wanted to run side by side. What would their tax liability be in scenario one, essentially before OBA was passed? So before July 4th, what would their projected tax liability be, assuming the basics that we already know about them? They have a little bit of taxable interest income. This is essentially money that's just sitting in cash, money markets, checking, savings. And they don't keep a ton in there, but they're earning about $1,500 a year in interest income. This is one thing I will just say to all of you folks that are approaching retirement or recently retired. Truthfully, even if you're not like on the brink of retirement, what I've oftentimes seen is clients are owning these type of interest-bearing investments in the wrong bucket. They load this type of investment inside of their taxable brokerage bucket, if you will. So again, the banking assets, maybe it's a taxable brokerage account, they're sitting there and now they're earning 4 or 5%. And maybe they've got $1 million in there or $500,000 in there. That's significant interest income. Assuming a 4% interest rate on $1 million, that's $40,000 a year. On $500,000, it's about $20,000 per year. And listen, it's not like that is insignificant. I'm not saying, hey, don't go chase yield, but ultimately that income is going to be added in the tax return on the 1040, rather than interest income that is owned inside of an IRA or a tax advantaged account that's not going to show up here. So thinking about where you're owning your tax inefficient investments and then therefore balancing that out with where you own your tax efficient investments. Definitely a big deal for the clients that we serve that have 7 figures plus inside of their investment portfolio, because that could add up $40,000, $50,000, $60,000 a year of a tax drag on your overall rate of return. This client, they're savvy. They keep a minimum amount of cash in there. And again, it's only $1,500 on an annual basis. It's not going to crush them from a tax perspective. Then we have their pension income here, and that totals $25,000 roughly on an annual basis. So given their needs, given some of their wants, we haven't really built in a ton of wishes yet. We've talked about some charitable giving over time, but for now, we're going to just start with their lifestyle in retirement. I find that folks that we serve that are right at the beginning phase of retirement, they kind of feel like, hey, let's make sure we can kind of maintain our lifestyle and be comfortable for a period of time and just make sure like, hey, this is working before they start to think about some of these big wishes. Maybe it's charitable giving, or maybe it's gifting to their children, or maybe it is, buying a vacation home, a second home, or maybe, doing summers or a part of the year. Maybe it's winters in another state even, and prolonged periods of time in an area that they love, and also potentially get some tax benefits as well. But ultimately, that's what I typically see is the needs, wants, and wishes will progress through retirement. It's not just like, hey, we're retired, now we're just going to go bonkers on our spending during the go-go years. It's kind of an easing phase. And I do find the clients that we serve, sometimes it's a little uncomfortable in that beginning phase of spending down the portfolio. But for this couple, for Jack and Barbara, we did a pretty good job. They did a really good job of budgeting and then figuring out what is that targeted withdrawal from the IRA that they need on a before tax basis to satisfy those needs, wants, and wishes. And the number that we came up with was just over $103,000 per year. So again, we're apples to apples here in all of our comparisons. Total income in both scenarios is $131,000 and some change. So far, so good. So one of the biggest changes pre-OBA versus post-OBA is with the standard deductions starting right away in 2025. For single taxpayers, that went up $750 straight off the bat. And then for married filing jointly, it went up $1,500. So as you can see, Jack and Barbara, they're actually going to get an increase in their standard deduction by $1,500 straight off the bat. Another deduction here that you'll notice is right here. That is an additional deduction for charitable giving. Qualified 501c3 donations, typically, if you are not itemizing your deduction, you don't actually get tax credit for that donation. Obviously, you don't want to not donate just because you're not getting a tax benefit. But if you can get a tax benefit while you're also being charitably inclined, while you're also donating to charity, might as well try to do that. So this is kind of like that piece of legislation that was passed in COVID. I can't remember if it was 21 and 22 or 2020 and 2021, but there was an additional deduction that you can just take regardless if you're taking the standard deduction for charitable giving. But I think it was only like $600 or $300 per taxpayer. For this scenario, for post-OBA, it's going to be $1,000 for singles and then $2,000 for a married couple. So this client, they're giving a little bit to charity, not a massive amount relative to their income, but they're giving $2,000 a year. And so now they're actually going to get a standard deduction here. So that's another $2,000 here on the positive side, post-OBA versus pre-OBA. But the big kicker here is this section here, this $12,000. This is a bonus deduction for those that are 65 plus. So if you turn 65 in 2025, you can qualify for this bonus deduction, and it's $6,000 per individual, $12,000 for a married couple. So right here, we have $6,000 times 2 for a total of $12,000. So that's an additional $12,000 on the post-OBA side in terms of deductions that they're getting just because they're 65 or older. Their taxable income is $15,500 less in this scenario here relative to the pre-OBA rules. So they are going to benefit from a tax standpoint. And obviously that shows up right here. They saved relative to the pre-OBA rules. We'll give it approximately $2,000 that they saved in taxes right there. Just no, they didn't do anything. They didn't change any strategy. They didn't change their tax situation. They didn't do anything differently. On July 4th, they woke up and now their taxable income is $15,500 less, and that's going to save them $2,000 back into their pocket. The goal here with the Trump administration is to essentially stimulate the economy. Put that $2,000 back in individuals and couples that are over the age of 65, and hopefully that stimulates growth, that stimulates the economy. It helps with the inflation concerns that many people have, the housing concerns that many people have, insurance costs going up, groceries going insane over the last few years. So this is part of the legislation, is putting that $2,000 back in your pocket. Now, the key is there are some income phase outs depending on what that adjusted gross income for the year. You potentially could be phased out of that bonus deduction. And we're going to talk about that in just a second. So just for fun, what I wanted to do was I wanted to just get a pulse check on what that rate of withdrawal is in the current year, 2025, and also project out long term. So if you take approximately 103K and you divide that into 2.1 million, that gives you approximately 4.9% as a rate of withdrawal. So we're pretty close to what that is, that's coming out there. So if you think about the 4% rule, this is pretty on par with that. 5% or less, that is a perfect spot to be. Even truthfully, in my opinion, a conservative spot to be, especially because they're still in that gap period. The gap period being pre-Social Security. You retire and you have no income. Maybe you're lucky and like them and they have a pension. The pension's giving them the baseline, right? So they're not relying 100% of the portfolio, but the pension is a small part of their total income, maybe 18%, 17%. So the majority in that gap period is rate of withdrawal, but it's under 5%. And then look what happens. All of a sudden, Jack takes Social Security at the beginning of the year, and then Barbara takes it at the end of the year, age 67, full retirement age, which, by the way, is still up for debate. They can delay as long as 70, and then they're going to get that 8% a year bump after their full retirement age. So that's an option if they're concerned about longevity. Maybe their portfolio is doing just fine to bridge the gap, but that bridge could be 2 years, or it could be potentially longer. It could go all the way up to here, age 70, or anything in between, right? So who knows what's going to happen? No one knows exactly how long they're going to live. So that just makes the Social Security timing decision a little bit tough. But again, then once Barbara's also in Social Security, the rate of withdrawal drops to about just over 1% a year. I mean, I'm not going to say it's impossible. It is virtually impossible to burn through your entire portfolio with a 1% annual withdrawal rate. It truthfully is, because again, like you could literally put the entire portfolio in US Treasuries right now for 30 years and lock in 4%. So, that takes care of 1% a year and some with inflation. But anyways, I digress. My point is there's a period of very low rate of withdrawal for this particular couple. But then once they turn 75, what is going on? The reason the rate of withdrawal then jumps is not because they're spending more, but because when they turn 75, that is when required minimum distributions, or RMDs, begin. Any of you out there who have tax-deferred retirement accounts, IRAs, 401ks, 403bs, TSPs, 457s, 401as, whatever it might be, you have a required minimum distribution. And it typically starts out just under 4%, like around 3.7%, that first RMD. And then it goes up over time because your life expectancy goes down. So the way the percentage is basically reverse engineered is they have a life expectancy factor. So, when you're, 75, you're expected to live maybe 20 years or 19 years. So you're dividing your portfolio balance by that period of time. And then it's going to spit out a percentage. So your RMD could actually go up and down over time, depending on what the account balance is doing, because that RMD is going to be calculated based on your balance at the end of December, at the market close on December 31. So on January 1, you'll know what your RMD is, because I guess technically you would know it on December 31 because the market closed, but sometimes things settle and the prices kind of change after market. So maybe let's call it January 1 or sometime the beginning of January. You take that portfolio balance and you divide it by that divisor based on your life expectancy. So each year you get older, that divisor goes down. So therefore, as a percentage, it goes up. But like in 2023, RMDs went down across the board because the markets dropped. And for retirees, a lot of them were invested not conservatively, but balanced, maybe 60% stocks, 40% bonds. So their portfolio dropped 19, 20% because stocks and bonds both did terribly that year. And so the RMD actually went down in 2023. So that was interesting. But anyways, if you look at the rate of withdrawal impact over time, we're at sub 4%. And then it goes up because that life expectancy factor hovers right around just under 4% and just over 4% for the duration of their lifetime. But the key is they're not even spending all of that portfolio, right? So some of that portfolio, what they're doing with that distribution, they're reinvesting it into their taxable brokerage account. So even though it shows up as a rate of withdrawal on this whiteboard, right, they're actually reinvesting a good chunk of that RMD. And evidenced by the year before, they're at just over 1% rate of withdrawal, and then it kicks up to 4%. So anyways, the majority of that RMD, they're reinvesting. So my point in this entire slide is this is a very conservative rate of withdrawal, but watch what happens from a tax standpoint over time. So right now, like I said, this couple, they're 65. Right now, they're in that 12% tax bracket. Okay, they're comfortably in that 12% tax bracket up until those RMDs kick in. That's age 75. And then look what happens. The tax bracket jumps up to 22%. Okay. You may think, oh, that's not that concerning. But going from 12 to 22% for 18 years plus, look what the impact is. And then all of a sudden, it spikes at the end. Now, what happens there? So the tax brackets are more favorable to married filing jointly relative to single, like just in terms of the amount of income you can earn. So what happens is if Jack predeceases Barbara right at this point in time, all of a sudden her tax bracket as a surviving spouse, that actually bumps up to 24% towards the end of this plan. And then it stays there for as long as she would live. Right. So here's what's going to happen. So one of the strategies, and I've talked about this before in Whiteboard Fireside Chat, is convert those assets, those tax deferred accounts before you hit that RMD tax trap. Okay. So what I like to call this, because pre-retirement, they were actually in the 22% bracket. So it was actually a good move for them deferring income in those pre-retirement years when they were at the 22. And then all of a sudden the tax bracket goes down to 12. This is what I like to call that Roth conversion window. So that's when you want to get aggressive with these conversions, is during that Roth conversion window in order to prevent that RMD tax trap. If you look at the next slide, look at what happens. Yes, what you're going to see is higher taxes early on in retirement relative to what it was before, but then a drop off for a prolonged period of time towards the end and staying low indefinitely during this plan. So there are many different brackets you can fill up with these Roth conversions. Let's say it makes sense for you. And it doesn't make sense for everybody. This is one of those things I oftentimes see advisors out there, talking heads online, whatever it might be. Everyone is just pushing Roth conversions. I'm telling you right now, with our practice in terms of looking at the numbers, it's about a 50-50. So it's about a 50-50 split between should you convert or shouldn't you convert. Okay. And so ultimately, if the numbers make sense for you, then you want to get aggressive with the Roth conversions. In this case, it is important. Thinking about the next generation is really what's important to them, and making sure that tax efficient legacy is in place just because of where their kids are from a tax standpoint. They are in a higher tax bracket, their children, their beneficiaries. So if they were to inherit all of those assets in tax deferred accounts, that's also a tax trap out there too, is the tax trap of the 10-year rule. That's my next Whiteboard Fireside Chat. The tax trap of the 10-year rule. That's an entirely different conversation, but probably next week on the Whiteboard Fireside Chat. And so their adult children are in that situation. So they want to make that legacy tax efficient. So they are in favor of converting. So there are multiple target brackets you can convert to. The 10% bracket, obviously, that would be super low, probably not very likely. 12%, okay, now we're adding a little bit of income, especially in that Roth conversion window, maybe pre-Social Security, no pension, and just living on your taxable brokerage account. Maybe the 12% adds a decent chunk of Roth conversions. Maybe it's the 22%, probably more likely. Maybe the 24%, potentially. Higher than that, the 32, 35, or 37. I don't see it a ton in my practice. I'm sure people are out there doing that. But I think it kind of depends on what your lifetime tax bracket looks like and how aggressive you need to be. In this case, it looks like the 22% bracket was the optimal one to fill out during that Roth conversion window. But even longer term, it shows the viability that they could potentially look to convert even longer than that. It just depends on how aggressive they want to be with Roth conversions. There could be an argument to not convert forever, filling up the 22% bracket. That's what this plan is defaulting to. The software is defaulting to. But another way to look at it is stop here at 75, or maybe do it for a period of time. But who knows? Tax legislation is going to change over time. And, even though things are permanent now, I guarantee things are going to change in a few years, 8 years, 10 years down the road. So you always want to reevaluate this. And that's why I look at these plans as like they're just plans on in this case, an iPad. But you've got to implement the plan, and then you have to manage to changes over time that are going to happen both with, not only with tax, but also with the markets or with your personal situation or family situation. But if they did the textbook, fill up the 22% bracket indefinitely, all of a sudden, obviously this is in their 80s. So longevity has to be on their side. The tax bracket falls to 12%, and then it stays there indefinitely. So if Barbara has longevity really in her side, but then also thinking about the next generation, these assets passing on, let's say most of these are, let's say, tax-free, let's say 100% tax-free legacy or the majority tax-free legacy. Maybe that's important to some people. Maybe it's not important to you. It just, everyone is going to have different goals, different circumstances in terms of A, if you do Roth conversions, B, what bracket to convert to and when, and then C, how long you do those conversions. So if we know in this situation, it's like, okay, maybe it makes sense for them to convert. And let's say we target that 22% bracket for a period of time. And let's say they do that indefinitely. Okay, let's look at the impact from a tax standpoint. So if I look at back to the tax planning software, and just to point out, this is pre-OBA, same deal, $1,500 interest income. We've got the IRA distributions for their cash flow needs. And then we have the pension income of $25,000. But now we baked in, here we go, a Roth conversion of $108,500. Again, this is pre-OBA. But here's the deal. Post-OBA, as we know, additional deductions that are available to age 65 and up. Okay, a slight increase in the standard deduction. We already talked about that, $1,500 standard deduction, so that's there. Okay, but here's the thing. You may be thinking, hey, they're going to have a lot more room to do all these Roth conversions that year. It's going to be way in excess of what they would do pre-OBA, $108,500. But if you look at this here, spoiler alert, it's only a $4,500 increase in the Roth conversion target. Because what I wanted to do is I just wanted to make like the tax liability apples to apples. That's how I came up with that. Is I'm like, hey, if an individual wanted to pay the same amount of taxes, basically, pre-OBA versus post-OBA, but their goal was to go aggressive conversions, how much more room do they have to pay that same amount of tax? That's how I came up with this, and it gave me $4,500. So that brings the taxable income here in scenario 2 to a little bit higher than scenario 1. Like I said, in the amount of about $4,500, but the total tax liability stayed basically the same. Okay, so it was basically the same. It was like, I don't know, $15 off. So we're right there in terms of total tax liability in scenario 1 and scenario 2. So you might be wondering, well, how did this happen? Well, if you look at the adjusted gross income number, as we looked at, the Roth conversion was a little bit higher. So there's a little bit more Roth conversion in there. But remember that other deduction here, that charitable deduction, that stays in place. That's $2,000 still to reduce that tax liability. And then that standard deduction, as we talked about, there's a slight positive here in the standard deduction that helps out. But here's why it didn't move the needle as much as you probably thought it would, is that there is a phase out. Because of the amount of income that they're converting, that IRA that they're converting, roughly, a little over $100,000, that's adding to their adjusted gross income. And now it's at $242,000, where in the OBA rules, if you're married filing jointly, once you earn $150,000, you're beginning to get phased out of that additional bonus deduction of $6,000 per person. So in this case, for married couples, they will completely phase out at $250,000 of income. So this couple is basically there. I mean, they're at $242,000. So they're basically there. So they're only getting this bonus deduction here in the amount of $931 as opposed to $12,000. So that is why that Roth conversion number is probably not as high as you thought it would be. Another thing to consider that when you're doing this size of a Roth conversion is some surtaxes, okay? So some excise taxes, if you will. In this case, it's a surcharge that you pay on your Medicare Part B and your Medicare Part D. And the amounts that you pay, that surplus you pay, there are 5 different tiers of these surcharges. They're also known as IRMA, Income Related Monthly Adjustment Amount. And if this couple did that conversion amount, their modified adjusted gross income is going to show up as $242,000. And that actually gets them into that first tier of actually paying IRMA tax. It's not a huge amount per person. It's $74 on Part B, and then $13 additional on Part D, whatever your Part D policy costs, plus that additional $13. For Medicare Part B, everyone pays $185, but then there is a potential IRMA surcharge if you are in one of these tiers. In this case, they're only in Tier 1, so it's not a huge deal. It is a married couple, so if you take 74 plus 13, we're talking about $87 on a monthly basis. But if you multiply that by 2, because this is a married couple, we're talking somewhere in the neighborhood of about $174 on a monthly basis that they would pay. So, we'll call it around $2,000 on an annual basis. So that is a factor to consider when you're doing these Roth conversions, are these IRMA surcharges, because once you get into the second tier, third tier and above, those numbers add up pretty quickly. So bottom line here, just because the tax law changed, just because the big beautiful bill passed, between the deduction phase outs with the new bonus deduction at 65, IRMA surcharges, and Social Security taxation, this stuff can get nuanced and complicated quickly. So you always need to run the numbers for your own plan relative to your own goals and your own financial situation. If you want a second set of eyes on this, this is what we do on a day-to-day basis. We help folks plan and execute a successful retirement to maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If you're interested in learning more about working with us, you can visit our website at www.imaginefinancialsecurity.com, or you can start with the retirement readiness questionnaire that is linked in the description. And if you want to dig deeper into the One Big Beautiful Bill and how it impacts folks like you, and get my take on some of the key planning opportunities, check out our latest podcast, which I will link as a video next. Until next week, we'll see you then. Thank you.